Welcome to TheoTrade. This is Don Kaufman. March 11th, 2022. There's 7 minutes to go to the cash close here. Doing the weekend update on a Friday afternoon. Have the depths of volatility and despair passed in this marketplace? We are going to answer that and much more on the weekend update. Let's get right to work with obviously some of the action in this marketplace. First, I'm going to tell you, I'm a little surprised. We've been trend down throughout the course of this Friday. And the reason that I'm surprised by it is you're not going to see volatility ripping to the upside today. I'm looking at the VIX, I'm looking at the volatility futures, like you're not feeling it today per se to the downside. And I must tell you, that to me, it doesn't feel good as a trader when you see sell side activity and the markets, they're just not responding. We're not seeing, that fear and loathing inside of trade. Nevertheless, 6 minutes left to play over here, and that sell side is picking up. Some of the volume is starting to pick up here. But before we go any further, let's discuss kind of the market as a whole, because individual stocks at this point, we're going to save for a little bit later. I mean, what is really being served up to us on a platter? Obviously, the S&Ps continue to slip throughout the course of the week. I think that the most effective way to display this isn't necessarily the S&P futures, but, more the SPX. The SPX, the mother of all products, was slated to move this week just about $145. And this is something we look at, consistently, week in and week out. All right, we hit the $145 move and then some, and we'll discuss expected moves a little bit later here in this video. Nevertheless, we are towards the lower edge of the expectations of movement throughout the course of the week. So what are we? We're lower on the week. What are we looking at inside of the NASDAQ? We'll actually cruise over to the NASDAQ briefly, go to auto expected moves. You can see there's a very mild breach at this point in time of the expected move specific to the NASDAQ. Last but definitely not least, the IWM. Interestingly enough, the small caps have actually fared relatively well this week. They're only down very, very mildly on the week. Now, this is of critical importance, in a moment when I discuss volatility, because it's one of the most pivotal things that I don't think it's being discussed really at all throughout the course of this week. But again, it really gives you a great indication, of forward risk. And that's exactly what we're going to discuss here momentarily. The other point, to be made is if you take a quick glance now at a 30-day 1 hour chart, first and foremost, we're right off that marquee level of 42.11. And it has been absolutely, marquee as of late. In fact, I'm even going to open this up to 180-day in the 4 hour, and you'll see how many times we just keep kind of hitting the level. All right, it's the kind of central point of some of this volatility trade in really just the last few weeks. Again, 42.11, all right, in the S&P futures. Now, let's snap back out, to a little bit of a broader chart. One thing you got to be aware of, this coming week, we're going into a primary options expiration. What does that mean for you? Well, it means there's a huge amount of open interest, that would be coming off the books later in the week. What that really amounts to? Volatility. I mean, if this wasn't enough volatility for you, you're going to get more towards the latter portions of next week. I'll bring you back up to speed on that as the week kind of progresses. Again, 2 minutes left to play in this week of trade. S&Ps are sitting right at the 4,200 mark. Let's get really into it. Let's get down to business here. All right. Volatility did not rise in the midst of the sell side. One of the key points to be made, and that's why I brought up the SPX to kind of kick this off. The SPX, is it considerably lower? Yeah, I mean, what's 120 points amongst friends? I mean, yes, the SPX is lower, okay, than the prior week. The point to be made over here, okay, this central line that I'm kind of highlighting, and that's effectively where the week started, and it's just a little bit below the 43.50 in the SPX, where we right now, okay, considerably lower. As I said, it's about 120 points lower inside of the SPX. At the exact same time, I want you to go look over at the VIX. If we look at VIX, and I'll also apply auto expected moves to VIX, the reason that I wanted to bring this to your attention, okay, you don't see this too often. See what? Well, in sheer respect to VIX, the VIX started the week right around 32. And again, I just wanted to highlight this for a moment. So the VIX starts right around 32, and it has actually come down almost a point. So we're going to end the week right around basically a 31 VIX, almost spot on, okay, in terms of a 31 VIX. And you have to think to yourself as a trader, like, what does this mean? The market's selling off. Like, it should be feeling it, man. Like, volatility should be pumping into this. And I'm telling you, this is not a pleasant sign. It's actually, this specifically is exactly why I'm calling this the depths of volatility and despair. We are starting to feel volatility complacency. It is not a warm and fuzzy feeling when you see S&Ps. I mean, hey, look at the market right now. SPOOs with 30 seconds to go are off 55 handles. The NASDAQ's down 300, okay? We're on fire right now to the downside. And the VIX, it can't get off the mat. It just can't get off the mat. You can take a look at volatility futures till you are blue in the face. The volatility futures, are they elevated? Yeah, but this is not the kind of elevation you see in a volatility contract, right? With the S&Ps down 1.3%. The NASDAQ's facing a 2% loss. There's the closing bell on the week. This thing couldn't have closed fast enough either. That was some pretty intense sell side into the close. But you're taking a look at these volatility futures, and again, you're just not feeling it. I mean, they're in backwardation. So I caution you, we're seeing volatility complacency. The market, okay, is starting to get tired. Traders get tired. Markets get tired. You're like, algorithms don't get tired. I would agree with that. All right. But this is an area to be very, very concerned about, especially if you are selling options premium, which we absolutely unequivocally are. I don't want to step in right now and start to sell options premium, okay, at the 4,200 level in the S&Ps, or any product for that matter. When the markets are selling off, you should feel more volatility coming into the marketplace. But you're not getting paid. You're not getting paid to take the risk. It's why I wanted to bring this to your attention. Option volumes have also subsided pretty considerably. Like yesterday, I was almost shocked. I mean, yesterday, yeah, it was a little bit of an inside day, but we only did like 35, almost 36 million option contracts, which is really light relative to some of the price action we've seen as of late. Again, I wanted to kick off with that because you're like, well, okay, so what's, the summation of this? Volatility didn't rise in the midst of selling. We're settling in right now, okay, to a substantially lower range. It's going to take a considerable break lower now in markets to kind of once again feel volatility really come up. And just throw that out there. Does that mean that we are going lower in the markets? Absolutely not. Okay. But when volatility again starts to kind of have some slack and the market is selling off, you realize that people are, it's throwing in the towel. They're like, it's just over, man. It's over. Okay. This is not a great feel for a marketplace at all. Moving on over here. Let's get into next week. Next week, I mean, listen, you've got geopolitical risk. It's all over us. Everybody's talking about inflation, the geopolitics. Geopolitical risk to me is one thing. It means the entire marketplace becomes a big binary mess. And if you've never really heard me use that discussion of binary. I mean, you look at this, and again, we're sitting right around this 42.11. By the way, I wouldn't be surprised if we pulled right back up to 42.11 by the time the futures close. We're at 42.11. We're at that pivotal spot. and we talk about like a 50-50 move. You're like, well, that's not helpful. But that's what binary means. You're a coin flip away each and every day from being 200 handles higher or 200 handles lower. And as I was saying, like, I don't like the fact that volatility is actually subsiding to a degree with, the geopolitical situation. Situation is coming to a head. It doesn't seem to matter. Now, in addition to all the geopolitical risk, and that's something, again, it's completely binary. Now we got to talk about the FOMC. I mean, we just went through CPI, and CPI was crazy, but let's talk about it, okay? The Fed is coming back, but to me, it's too little too late, okay? This week, yes, there's going to be an FOMC announcement. And I like to bring this up in terms of the SPX. And the reason I'm bringing up the SPX, just to show you, okay, each and every day. So there's, a 3-day expiration. That's Monday's expiration. Then there's Wednesday expiration. There's a little extra volatility packed in there. Then, of course, Friday's expiration. So lo and behold, yeah, there's a little bit more risk packed in throughout the course of the week for the FOMC, but nothing considerable. Why? No one cares. The Fed meeting, the quarter point, okay, increase, it's already baked into the marketplace. They're also going to discuss quantitative tightening. It's going to be underway. So instead of actually, tapering, we're going to quantitative tightening. We're literally going from one extreme to the next extreme instantaneously. You got to love the Fed. Okay. CPI was 7.9%. All right. And really the inflation, okay, will turn into stagflation. That's my own take. Now, I'm going to push that aside for just a moment because I'm not telling you anything, okay, with all due respect, that you don't already know. And again, I think that the FOMC discussion is so overdone. Quarter point, yeah, they're going to bump it up as long as there is geopolitical risk, as long as there's sanctions and it's a risk, okay, they're not going to do anything more, okay, than kind of sputter along. When I say they, I reference, okay, the Fed. All right, so the Fed's going to come out. They're going to say, oh, I saw my shadow. All right, they're going to raise by a quarter point. They're going to talk about quantitative, tightening and yada, yada, yada. That's it. In the marketplace, what's it going to do? Not much. I mean, again, you just saw CPI. I think that's what matters even more. Inflation is driving out of control. Now, let's talk about what really matters. What really matters, the bond market, okay? Bonds, again, strictly from my perspective, they got to do what the Fed will not. And what is that? They got to jam rates, okay? They got to jam rates higher. Rates to pop. I would look for this coming to a theater near you. Look at the 10-year. It needs to pop. The short end of the curve. What's the short end of the curve? He's talking about like the 5-year, 5-year, okay, 10-year. They're going to pop higher. With all due respect, we are seeing some of the most wild inflation since 1982. I know it was a very good year, right? But we're seeing some of the most wild inflation, okay, since the 1980s. I'm going to open up a 15-year chart on the TNX, and the TNX is the 10-year treasury. Now, where is the TNX presently? Okay, and you can see here it is. Basically, we're sitting at 2%. 20 means 2%. Okay, if you just look back at the average, if you will, all right, since all of this, it's somewhere in this neighborhood, which is probably 2.5%. The only point that I'm going to make initially, all right, get me to 2.5%, all right, and I'll reassess. But at this point in time, okay, if the Fed is not going to jam rates higher to kind of cool off a little bit of inflation, then somebody needs to, and that is going to be trade, right? So look for the 10-year to climb. Look for the shorter end of the curve. Again, shorter end of the curve, all right, is again going to be like the 5-year, the 2-year. Look for the rates, the interest rates to climb. Inversely, that would imply, okay, that the bonds are going to see some sell-side activity. What's the only way that I see the bonds rallying? I could see, and I'm taking the other side of myself here for a second, I could see the bonds rallying if the S&Ps went into an absolute spiral, out of control, downward move. If we crossed from like 4,200 right down through 4,000 in a day. Fear and loathing inside of the marketplace. I can see the bonds rallying, but I believe it's going to be short-lived. You got a situation right now. Bonds are going to sell off. Equities are going to continue to sell off. By the way, junk, go take a look at junk. Okay, junk, the yields need to fly. Again, the implication is if you take a look at junk over like the last 5 years, you ain't seen nothing yet. Junk is going to get crazy, all right? And I mean crazy to the downside. Look for a wicked, unrelenting move inside of junk. And you go, why are you so negative, man? Why are you so negative about junk? I'm negative on junk because the yield is sitting at 4.56. Are you kidding me? So what is junk? It's degenerate borrowing. Degenerate borrowing isn't even keeping up with CPI. Do you not see, okay, the issue there? You know, you got CPI coming out at 7.9%. Inflation is sky high. Junk yields, okay, they're not doing it. We're not doing it. Junk, again, is going to sell off. Yields are going to go higher inside of junk. Yields are going to go higher inside of the 10-year. Okay, get ready to rumble. Because, again, the bond markets, the notes, they're going to do what the Fed is not. All right, let's jump over to the financials for a moment. Financials, they've been pivotal. Listen, at this point in time, okay, I don't even want to comment that much on energy because energy has really, it's become a bit of a free-for-all. I mean, like you can look at XLE, and when I say it's become a free-for-all, maybe it's topped out here, maybe it hasn't, but there's like literally too much geopolitical risk for me to even discuss energy. And I am carrying positions in energy, and I'm short, not in a big way, but I am short a little bit of XLE, okay? And I'm going to throw that aside. But with all the geopolitical kind of tension in there, I don't necessarily want to heavily discuss that. I want to discuss, though, what is moving markets right now. And it's not so much energy. Yes, oil shooting up and a commodity kind of super cycle to the upside is absolutely unequivocally causing pressure to the S&Ps, right? I mean, if you know anything about the nickel markets, the London Metal Exchange, it's been closed since Tuesday. They hope to get it open by Monday or Tuesday of next week due to, ridiculous size margin calls, which actually brings me from that commodity market. It's actually, I wanted to lead into this from the commodity market. We got to go to the financials because the financials, I'm a little bit concerned at this point. If you take a look at the financials, okay, in terms of auto expected moves, they didn't fare too badly this week, but they've been getting beaten up lately. I mean, the financials are playing catch up to the downside. Like, look, the financials are down now almost 8% on a year-to-date basis. If you look at the S&Ps, they're down 12%. So what am I telling you? The financials are still faring better, okay? Better than the S&Ps on a year-to-date basis. What's getting crushed? The QQQ. Don't worry, it's only down 19%. I mean, it's not good. We're in bear market territory. No question about it. The NASDAQ is a bear. The bears are on the loose. But the financials, that's why I'm covering it right now, okay? Are margin and sanction hits forthcoming? When I say margin and sanction hits, maybe people don't understand that, but there's exposure to geopolitical risk. We've already heard that JP Morgan, okay, specifically JP Morgan, has pretty considerable exposure, all right? And that JP Morgan risk, and I'm going to show you year to date, it's already being priced in. They see it, okay? JP Morgan is down 20%. Take a look at Citi. It's only down 14%. Take a look at Bank of America. It's only down 12%. Take a look at like Morgan Stanley. We're just jumping around about 15%. But the marketplace is pretty sharp this way, and it knows who has risk and who doesn't, right? So exposure to geopolitical risk, specifically JP Morgan had sanction type risk, but there's more out there. There's commodity exposure. There's margin exposure. There's what I would term sanction shock. And global financial stability has yet to be called into question. Now, all of the geopolitical risk, okay, is for nothing, all right, if this discussion like, hey, listen, things could work their way right through, okay? Everybody could be high-fiving one another by next week, and this could all be over. But I'm telling you, in the financials, from a entire sector perspective, I don't think the financials have actually priced in enough to the downside. And I do believe that the financials, once again, we could see some rip your face off rallies throughout the course of next week. But the financials, all right, beg to be hit and hit harder. I don't care if there's going to be a rising interest rate environment. Okay. The Fed, the stability of the marketplace, commodity hits, sanction hits. There is so much right now weighing on this particular sector. My assumption, once again, they will play catch up to the downside. And I will reiterate that again throughout the course of this week. Next over here, a very blatant statement I am about to make. The NASDAQ, okay? You can see it, you can feel it. Mega market caps. What am I referencing with mega market caps, right? This is what I term the monsters of tech. If you take a quick glance with me over at Microsoft, it's down about 16% on a year-to-date basis. Apple, it's off about 15%. Okay, Netflix is getting decimated. It's down 43%. Amazon, okay, Amazon's only off about 14%. Amazon with some, very positive news this week, but take a look at Amazon on the week. After all the positivity, we will finish massively unchanged in the week. That's why I use this auto expected move. Facebook, okay, can't get out of its own way. It's getting decimated right now, down some 44%. Google starting to take some hits. Remember, Google to me is, all right, the mega market cap. Obviously, Tesla taking huge hits. Nvidia down 26%. Mega market caps. To me, the great unwind has begun. All right. The ones you really want to watch unequivocally are going to be Google. It's going to be Apple and it's going to be Microsoft. Watch them in the days and weeks to come, right? When I'm talking about mega market cap and an unwind, you have to stand back, okay? Behold. Under the stock highlights here, you're still looking at Apple at a $2.5 trillion company. So why am I calling for the mega market cap unwind? Because the one aspect that a lot of people haven't necessarily thought about and haven't really explored deeply, we have yet to see any redemptions per se, like on mutual funds and 401ks and IRAs. Okay, real selling has yet to actually grip hold of this marketplace. That's not meant to intimidate, to scare. But if you look at the most widely held products, which are going to be Apple, it's going to be Microsoft, that's what brings them to $2 trillion market caps plus, right? Those are now going to suffer at this point. And there hasn't been extended sell side in here. But when you start to open up like a 15-year chart, the damage that's currently being inflicted to Apple, and now you can see it on a 15-year chart. To Microsoft, unequivocally, all right? Now we're actually going to see, again, the mega market caps feel like they're going to start unwinding. You're already in bear market territory in the NASDAQ. So, again, sit back and wait, watch the ride. Hopefully, if you see sell side in Microsoft and Apple, it picks up the volatility in the marketplace and we're off to the races again. Again, it is not a pretty picture, obviously, that I am portraying, okay, for the days ahead. But that's why I'm saying, have the depths of volatility and despair passed? Absolutely not. All right. We haven't actually gotten into the heavier selling. There's another way that I like to kind of look at this. And if you will, I'm going to go ahead and close up this left side bar and I'm going to show you like a 5-year chart inside of Microsoft. Look how light the volume is. There's been a couple big days in here, okay? Those big days, though, related to earnings. Look at the 5-year chart. Do you see huge volume? Because I sure don't. Back here is the COVID crash, right? There was some serious volatility even back here. Right now, there's nothing. You go take a look at all of your favorite mega market caps. In fact, even when you start to look at a product like the spiders, again, the spiders are just starting to pick their head up off the mat and see some real volume. Again, this is a weekly chart, right? It's a weekly chart, and this has been going on now long enough. I mean, the move that we're presently seeing in the S&Ps is now longer than the move that we saw and the onset of COVID, right? The COVID crash was over and done with inside of 3 weeks. We've been in sell side activity now. Hey, look at your calendar. It's mid-March already. It's getting a little bit more serious, but now we're at the point where the situation is going to come to a head. Last, but definitely not least, as we do each and every week, I'm going to update you on expectations of movement. This past week, right, just about $147 expected move. What are we looking at for next week? Next week, about 144 and change. Almost identical. So the reason I'm bringing this to your attention is you would think with an FOMC announcement and the markets have really been rocking this week that volatility would have been higher, but it's not. Okay, it absolutely is not. Volatility is basically the same. In fact, longer term volatility is slightly lower than it was this previous week. Okay, what can be learned from that? The FOMC is largely priced in. What can be learned from that? It's all about geopolitical risk. It's all a binary marketplace. Listen, throughout the course of these next, few days, few weeks, just keep your hands and feet inside of the vehicle at all times. This is going to be a rough few weeks in the marketplace. All of a sudden, we're going to be looking at geopolitics, and then we're going to shift back to inflation, right? There's going to be an inflection point in there that is going to be violent. All right. And you're going to see some huge rip your face off rallies. Those, okay, are the hallmarks of volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.